Silver didn't just pull back, it was halted. 159 million ounces traded during the halt. Lease rates just spiked above 1%. Swap rates went deeply negative. And the largest SLV holder quietly built a $1.3 billion position. If you think this is random volatility, you're missing the structure underneath the price. Today we're connecting the halt, the hedge fund positioning, the derivatives stress, Shanghai premiums, collapsing open interest, and what it all means for the real silver market. This isn't about hype. It's about understanding how the system actually works. After Wednesday's halt, silver dropped to 87. The 87-20-89 zone, former resistance, flipped into support. It held. Price bounced to 90, then failed hard, dumped to 85, now hovering around 86. The 150 EMA near 85 has acted as support before. It's a confluence level, not certainty, but structure. Here's the key. The moves are sharp, emotional, fast. That's not long-term positioning, that's short-term volatility engineering. And when volatility spikes around delivery periods, you need to ask why. News broke that Jane Street added 20.6 million shares of iShares Silver Trust, SLV, in Q4, making them the largest holder with roughly a 1.3 billion position. Ask yourself, do firms like this accumulate that size to wait patiently for a 5-year bull run? Or do they accumulate size to control short-term volatility? This isn't bullish or bearish, this is about structure. When quantitative firms hold massive ETF positions, they gain influence over short-term flows. That influence becomes edge, and edge is extracted from emotional traders. In India, Securities and Exchange Board of India accused Jane Street of generating roughly $550 to $567 million in unlawful gains tied to alleged manipulation strategies around expiry days. They were temporarily barred in July 2025, later conditionally reinstated, funds deposited into escrow, appeals ongoing. They're also under regulatory scrutiny in China. This isn't conspiracy theory, this is documented regulatory action. And similar volatility strategies appear across multiple markets, including crypto. The structure looks like this: accumulate spot exposure, buy cheap downside options when sentiment turns bullish, trigger heavy selling, let panic and stop losses cascade, profit from options, reaccumulate lower, squeeze shorts, repeat. Does that mean every move is manipulation? No, but when volatility clusters around key delivery windows, it's not irrational to examine structure. During the halt, 31,128 contracts traded. That's roughly 159 million ounces of silver. Retail couldn't access the market, yet volume printed. You don't see significant volume during halts unless something is settling off exchange. This was the second major halt in 3 months. Both occurred right before first notice day of large contract months. That's not random timing. When halts cluster around delivery periods, it suggests stress management, not technical glitches. Price is noise, structure is signal. Let's talk physical stress. Lease rates, 2023 average, 0.04%. 2024 average, 0.18%. Today, 1.6%. Anything above 1.5% signals stress. At 1.6%, borrowers are paying unusually high rates to secure physical silver. That's not speculative demand. That's delivery necessity. Swap rates currently around 2.8%. Participants are paying to secure silver today and return it later. In theory, this creates arbitrage. If nobody scales that arbitrage, it means one thing: the market doesn't trust future availability. That's structural. Shanghai spot, cheers to 97. Shanghai futures, 100. Western spot, person 86. That's an $11 physical premium in the East. When that premium persists through failed breakouts and halts, it's not a temporary mispricing. It's separation between physical and paper. The Shanghai Futures Exchange even suspended 25 trading groups in February for position limit violations. Meanwhile, Western paper markets show collapsing open interest. When open interest drops to record lows while physical premiums persist, participants are reducing paper exposure. That signals counterparty caution. Around 2020, the U.S. Securities and Exchange Commission and Commodity Futures Trading Commission relaxed certain ETF-related derivative and transparency rules. From 2020 onward, Jane Street's profits surged, exceeding $20 billion in peak years. Correlation isn't proof, but sophisticated participants track rule changes alongside profit curves. Regulators loosen oversight, volatility specialists thrive, enforcement actions appear overseas, patterns matter. Registered silver backing futures has fallen to around 86.3 million ounces. Open interest is near historic lows. March roll moved 71 million ounces forward into later months, relieving immediate pressure. But rolling contracts doesn't create metal, it delays obligation. The system can absorb gradual increases. What it struggles with is velocity. Rapid demand that forces physical settlement faster than contracts can be rolled. That's when halts appear. The Securities and Exchange Board of India recently allowed $385 billion in actively managed equity funds to allocate up to 35% into gold and silver instruments. That's institutional capital getting permission to rotate into hard assets. Indian retail already favors gold ETFs heavily. Institutional participation changes scale. Central banks accumulating gold at record pace. Sovereign wealth funds increasing hard asset exposure. Industrial demand steady in key sectors. That's macro positioning, not day trading. Silver is down roughly 27% from recent highs. Silver mining stocks down about 6-7%. When miners outperform the underlying metal during corrections, it's often a structural signal. Companies closest to production aren't behaving like demand is collapsing. They're behaving like this is consolidation, not collapse. What could postpone upside? Large ETF holders controlling short-term volatility. Shanghai premiums narrowing if Chinese industrial demand softens. Continued contract rolling into May, July. Successful volatility suppression around delivery windows. That's realistic. But here's the counterweight. Lease rates don't spike without stress. Swap rates don't go deeply negative without supply concern. Premiums don't persist without physical tightness. Open interest doesn't collapse when confidence is high. Paper games can manage sentiment. They can't manufacture silver. Stop reacting to every $5 candle. Volatility is where firms extract profit from emotion. Patience is where long-term participants extract structural gains. Lease rates, swap rates, Shanghai premiums, COMEX, registered inventories, open interest trends, not just intraday price. Because when derivatives scream scarcity while price chops sideways, that's the tension before repricing. This isn't about predicting tomorrow's candle. It's about recognizing when physical reality diverges from paper pricing. Delivery stress clusters around halts, institutional positioning precedes retail awareness. The paper games work until they don't. And when that shift happens, it doesn't move slowly, it moves fast. If you understand the structure before the crowd does, you don't panic during the chop. You position for the repricing. That's the difference between reacting to volatility and understanding the war underneath it.